Hi, and thanks for watching the 12% Solution. Today we're going to talk about market rotation and momentum investing so that you, with a strategy, can consistently beat the S&P 500. Since the inception of the Standard & Poor's Composite Index, or famously the S&P 500, back in 1957, investors have sought to beat the street, which is basically to earn returns consistently higher than this famous fund, a fund which is comprised of the 500 largest companies in the United States. One strategy often implemented to capture larger profits and higher returns than merely holding a mutual fund or ETF that tracks the S&P 500 is to embrace market rotation. This is trading in and out of investments in anticipation of market movement. The concept of market rotation is wedded to the phenomenon known as momentum. Okay, we all remember from high school physics that an object in motion stays in motion unless acted upon by a resisting force, thus momentum. This concept relates to the principle of investing as well. Momentum investing holds that trends can persist for some time, and by identifying these trends, it is possible to profit by riding them out to their conclusion. Rotation investing, based on tracking momentum, is at the core of the strategy behind the 12% Solution. Here's the basic idea. Whatever index is outperforming should continue to outperform for a period of time. When that time is up, another index previously out of favor will rise to take the place of the previous performer. That's when you, as the investor, rotate from one to the other. Usually, when market rotation is discussed, it's discussed based on sector. And rightly so, because market rotation is often thought of as sector rotation. This requires understanding the basic cycles of the market, which essentially include four primary stages. Stage one is the bottom. This is the low point, the falling out, the bad news. This is followed then by stage two, also known as the bull market. This is where it's fun. It's the rallying stage, it's the growth and the recovery. This is where we remind ourselves that investing actually can be exciting and worthwhile. But of course, stage two is followed by stage three. This is that plateau where the bull market reaches its peak and starts the downward slide. A slide into stage four, known as the bear market. The bear wears us all the way down until we're ready to repeat stage one, and thus the four cycles of the market. Investors using sector rotation will base their strategy on where the market is with regard to cycle in order to understand whether or not it's worth investing in a sector like technology or energy or consumer staples, and so on. But for our strategy, we're going to ignore sector rotation. Why? Because it keeps us glued to the screen. That's right, it keeps us sitting at our computers staring at the glowing orb, afraid to walk away lest a sector start to turn, because when they turn quick. This is a hands-on-deck approach. And with the 12% Solution, we favor something with less stress and lower time commitment. So rather than sectors, we're going to stick with broader market indices, as they provide a little more stability and thus less volatility, because they're already made up of more diverse businesses. Take the S&P 500 as the flagship example. Comprised of the 500 largest companies, it is by nature a picture of investment diversity. Our favorite ETF, it's an exchange-traded fund that tracks it, is known as SPY, or SPY. It's also the largest ETF in the world, and for good reason. Buying shares in SPY enables the investor to own a piece of all 500 companies, and thus diversify his investment despite having one holding. So that's our challenge. We have to find indices that are occasionally able to best SPY, which is no easy task, given that the 500 stocks that make it up are widely regarded as the most accurate gauge of the large cap sector of the US stock market. Therefore, it's kind of like a microcosm of the American stock market as a whole. So, in short, we have our work cut out for us. Now, we're going to start by ruling out world or global indices, and we're going to focus on the US market for our particular strategy. For those of you who might be bothered by this, consider that the S&P 500, despite representing US companies, still has a considerable percentage of international influence. In fact, in 2018, The collective companies in the S&P generated 42% of their sales from foreign markets. That's diversification. Even though we've ruled out world and global indices, we still have quite a few of choices to sift through. Do we focus on indices based on an exchange, like the NASDAQ 100 or the New York Stock Exchange US 100? Or do we look at indices based on price-weighted or market capitalization-weighted stocks? As an aside, there's a difference between these two categories, and it can best be illustrated by the difference between the Dow Jones and the S&P. The Dow Jones represents a mere 30 companies versus the 500 in the S&P. And the Dow Jones is what's called a price-weighted index, which basically means that the companies with the larger stock price more heavily influence the overall fund. This is opposed to the S&P, which is weighted based on the market capitalization of the company. Here's the easiest way to think of market capitalization: the measurement of a company's size. A company is going to be classified as mega cap or large cap, mid cap, and small cap. This has to do with the number of shares that a company has multiplied by the price of the shares. That's how you get the total market capitalization. So take a company like Nike, for example. They have a share price of around $130 as of June 18, 2021, but the market cap is over $200 billion. In a fund like the Dow Jones, the share price factors more than the market capitalization. So companies with stocks that have not split or that are priced high but have smaller sizes actually have greater influence overall. That's why some investors favor the S&P, because it is a market capitalization index. Fortunately, the heavy lifting has already been done. And thanks to David Alan Carter's work in the 12% solution, we have a handful of contenders that beat SPY or SPY on occasion over the course of 10 years of backtesting without negatively impacting the overall returns. Note what I just said: without negatively impacting the overall returns. Every index will beat the S&P 500 at some point, some snapshot in time. But we are avoiding those with less predictability and higher volatility. That's because these funds are often fraught with reversals in short periods of time. We want indices that are both relatively stable and that can telegraph trends in a way that we can visualize and take advantage of, all while trading just once a month. Our strategy, therefore, uses the following indices. First is the Russell 2000 Index. This is a small cap stock market index of the bottom 2,000 stocks in the Russell 3000 Index, which is an index made up of the 3,000 largest companies publicly held in America as measured by total market capitalization. Second is the Standard & Poor's Mid-Cap 400, also known as the S&P 400, which focuses on U.S. companies with a total market capitalization between $1.4 billion and $5 billion. This is considered a sort of barometer for the U.S. mid-cap sector. The third is the NASDAQ 100 Index, which includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market exchange based on market capitalization. Add that to SPY tracking the S&P 500, and you have a key foundation to the 12% solution. There's more, of course, than our list of 4 popular market indices. And when we put our strategy to work, the momentum leader of that list will be identified. A hedge will be put in place to reduce volatility, and a cash trigger will be waiting in the wings to offer further protection during severe market corrections. Please note that the 12% solution is a DIY strategy, focusing on maximizing returns while minimizing risk, all while trading just once a month. You see, that's the key. Finding the freedom to go about your life with less worry because you are reducing volatility and risk through smart investing. Now, to get the full strategy, you can order the book on Amazon through the link in the description. And, for a little icing on the cake, join the free newsletter that sends out the specific trade or trades required each month. Hopefully you found this information helpful. Please leave us a comment to let us know what you'd like to see out of some of our future videos. But also make sure that you've subscribed so you don't miss any of those future videos. Videos that will help you start building your wealth today.